Well, good morning, John. It's good to see you once again. We're recording this on Thursday morning. John, yesterday we got Australia's national accounts out. So it looks like the December quarter we had growth of 0.6%. And finally, after 7 consecutive quarters of per capita decreases, we edged slightly into positive territory. What did you make of it all?
Well, it's good. I think it's nothing astounding by it. Time will work out some of the issues, and the catch up in wages, because wages have for the last 18 months increased faster than inflation, but they were a long way below inflation coming out of COVID for about a year and a half. So the catch up has occurred. Wages have now caught up with inflation, past inflation. Per capita income's only growing very mildly, Paul, but it's positive, which is good. And it sets the scene for a reasonable 2025-26, subject to what Trump does and the world order and some of the election promises which are coming thick and fast as we talk.
Yeah, so we've come to the end of the reporting season in Australia. What was your take? I kind of felt it was ho-hum, not very exciting, but at least the forecast for 25 and 26 didn't seem to slip too much. Valuations, one PE multiple down. So instead of the market being at about 19, it's now at about 18 times. How did you see reporting season, John?
Well, at the top end of the market, which is really banks, financials, and resources, we had resources not growing or negative earnings.
Yeah.
Which was disappointing given the weak currency and the sustainability or the sustained price of iron ore. So that was disappointing. And I guess the next 12 months is fairly flat outlook. Banks, the star bank is Commonwealth Bank, which grew earnings 2%. So the earnings growth is just not there for about more than half the market. So more action in the middle market, as many surprises, as many disappointments. And the overwhelming issue was the lack of dividend growth coming out of the market. Yeah. So really, Australian companies have pushed dividends to the extreme, and now they're struggling to sustain it. I guess a little bit of a positive was Telstra, which is in our portfolio. So that was a nice, and it's done quite well in a very poor market in the last few weeks. So that's good news for us. And our slant to income in a lot of our portfolios is holding our portfolios quite nicely. So from our perspective, the market is playing out as we predicted. Some of the high flying stocks are being knocked for six,
Yes.
as we know, WiseTech. So, steady as we go. Not a lot of yield growth in the market, not a lot of earnings momentum in the market, but the underlying economy is okay, given, as we said in your first question regarding GDP. So I guess we then focus on what's happening around the world.
Just before we move off, so I noticed that the dividend payout ratio seems to have slipped from just above 70 to kind of 67 thereabouts. Is that because Australian corporates feel the need to rebuild balance sheets after an extended period of high interest rates, or
possibly? I mean, I listened to the Treasurer this morning, and when he delved into the GDP numbers, he did point out that private investment had picked up. So business investment had picked up into the December quarter. So if that's picking up, that's a retained maintenance of capital. So rather than paying capital out, retain it and start investing. So if dividends don't grow because earnings aren't growing, that's a concern. But if dividends don't grow because there is reinvestment going on, that's positive for the future. Now, the Treasurer's slant was that he saw growth in private investment. One quarter does not create a spring or summer, so we've got to see how this plays out. I think there is caution. I think we've got an election coming up. We've got a lot of issues around tariffs. The bigger companies obviously are waiting to see how the tariffs play out. So the big exporters, the resources. So there could be as you say, repair of balance sheet. A little bit of gearing occurred coming out of COVID. Interest rates have gone up. logical to start paying down debt if you can. But hopefully it's a combination of debt repayment, improvement in balance sheet, and investment in growth.
Yes, and moving offshore, I saw that the Chinese national meeting was held yesterday, and they reiterated the 5% growth target, and commodity prices seem to be kind of holding up.
Well, I'll just go on to that one, Paul. And
Yeah.
I'm doing presentations. I think I've got one coming up in Adelaide in a few weeks. But as I said last year, if you look at growth and compare it to fiscal positions of these countries, there's been a significant change in China. So they're running big deficits, and their growth, their economic growth, is matching their deficit. That wasn't the case 10 years ago, where their growth was 3 or 4 times their deficit. Go across to America, and this is the big issue which the administration is trying to deal with. They're running 5 and 6% deficits and growing at 3%. I have this conversion in my head. You know, if the government is pump priming the economy, then the economic growth compared to the deficit is an interesting mathematical analysis to do. And we're seeing China follow the American cycle, where they're spending $1 and getting 50% growth. That's not great. That's not a great multiplier. And time will tell whether Trump's strategy of trying to bring back manufacturing and industrial production to America, if it came off, that's the right strategy, you know. But he's causing a lot of chaos as he tries to do that. And I think there's not a very good disclosure that America's financial situation, its balance sheet, is very, very leveraged at present. The American government has a lot of debt, and its tax collection is not that great.
Very interesting. Other stuff happening overseas. I see the Germans have overturned the brake on their spending so that they can amp up their defence spending, and so we saw German bonds shoot through the roof yesterday.
Yeah, but German's share market this week, and
It's been very strong.
Well, it went up 3%, down 2.5%, and up 3% last night. Now, I've just come out of an investment meeting, and one of the things we're observing, or I think is clear to see, as we ratchet up defence spending, and Australia has been given a bit of a message by America to increase our, I think it's per capita investment. So, GDP per GDP investment from around 2% of GDP to 3%. So quite a significant increase in defence, which would take, when you look at the budget, so the budget's about 25% of GDP. So when you start ratcheting up from 2% of GDP to 3%, you're going from about 7% of the budget to 10%. They're quite significant numbers. But that's also going to happen in Europe. And you mentioned earlier about China. China is spending, 10 to 12 times as much on defence as Australia is. Now they can, because they're a much bigger economy. But we are seeing a ratcheting up, Paul, of major investment in defence. Now, that again is industrial production. It might not be the best industrial production because it's not actually, building infrastructure which can get a multiplier effect for the economy, but it is investment. So you'd have to say the outlook for iron ore through steel is quite positive. So, I think we're going to be stuck at $100. If Europe and the rest of the world starts coming into defence, that's good for steel. And then we've had the copper price, Paul. I don't know if anyone's noticed, but it's got up.
I noticed.
Yeah. And now copper is one of your best indicators of economic activity.
Yeah.
So it may be that in Europe, which has had very weak private investment, there's going to be a ratcheting up of government investment in defence. Okay, so that gets industrial activity going. Meanwhile, Europe is cutting interest rates, and I think they're likely to cut interest rates again tonight. So that's why the German stock market is dragging up the French stock market, the Italian stock market, and the UK stock market's pretty well on an all-time high. This bringing back together NATO and shaking the trees, which Trump's done, and getting these people focused, these leaders focused on defending themselves, is having a positive effect on economic activity in Europe after a decade of not much happening. So there are positives, and I think there's too much negativity about Trump.
Yeah.
And there's a lot to be concerned about with tariffs, but it is shaking, And I want to also, I sent you something this morning on the BRICs.
Yeah.
I think that's worth noting. And,
So what's occurred there is that Indonesia has decided to join the BRICs. There was the Brazil, Russia, India, China, and South Africa association, and it seems to be gaining a little bit of momentum. So what's Indonesia wanting out of that?
well, they're being bipartisan and tried to keep right away from taking sides. But now they have. But it's
Yeah.
economic, it's not defence. But they've joined, and Iran is there, and Egypt and a few other Middle Eastern countries. I mean, what Trump has done is created a disturbance, and countries are now thinking about their future, their trade future, which then leads to their defence future. And he's putting some resolve into the development of BRICS. I was on the record late last year saying, the G7 is not very thoughtful. NATO is one thing, but the G7, and I pointed out that India, as the fourth largest economy in the world and a democracy, and speaking English, really should be part of the G7.
Yeah.
And they're over in the BRICS camp. So we have to watch this. And China is driving that. Let's just see how Ukraine works out and what deal Trump is doing with Russia, because Russia is in BRICS. I do have a view that one of the core policy focuses of Trump is to get the oil price down. We're seeing weakness in the oil price. No one can explain it. We've got all this upheaval, yet the oil price is falling. $68, I think, last night. That will be very good for inflation.
Yeah.
Petrol prices in Australia, sporadically getting to lows we haven't seen for 2 years. So there's a lot of moving parts here, and I'm not as negative as a lot of people are. And if Australia can sit on the sideshow and not get embroiled in tariffs with America, and just supply the world with what it needs, and get some focus on our own internal growth issues, then we're fine.
Yeah. It's so interesting, talking about Indonesia, where they've devoted a huge expenditure to developing their nickel industry at the time when Australia is closing down, nickel production. So I don't know whether they're doing it mainly with the help of China, which possibly wouldn't be acceptable in Australian terms, but at least they seem to be, doing something and creating a new industry.
Yeah. Well, when you start interfering, as Trump is doing in the World Trade Order, then governments have to step up and get involved.
Yeah.
Now, we're seeing it in Europe with NATO and defence. Australia's got a challenge here, and this is a challenge to both political parties, and that's why I'd like to see some bipartisan thought process. What industries do we need to support? Now, we do have service industries, right? But a lot of that's internal looking, aged care, mainly education. We need to develop some manufacturing and industrial production in this place. So I'm not against a policy which actually drives capital, government capital, taxpayer capital, future fund capital, pension fund capital, and drives it into forming a broader industrial base for Australia. Otherwise, we are caught in these world trade discussions and without a policy designed to control our future or develop our future. And we are exposed because we're so weak on industrial production and so reliant on imports. Thank God we have this stir-up, which will be positive for commodities. Without that, we'd be in a very difficult situation. But where I see it, we're okay.
Okay. All right. We'll leave it there, John. Thanks. A really interesting discussion, and we will leave it there. See you next week.
See you next week.